Well, we got a great show in store for you today in this week's podcast. In addition to talking about the market-moving events of the week and all of the economic data points that came out, we're also going to talk about the launch of the iPhone 6 and really how it shows the difference between the strengths that underlie the Chinese economy and the weaknesses in the U.S. economy. I'm going to talk about a recent loss that I had, or a partial loss in an arbitration in a case that nobody could have believed I could have lost. So we're going to talk about the facts of that and really, what it means not only for the security industry, but for people who want to have a business and have employees in the United States, how difficult the government makes that. We're talking a lot about the housing market rolling over, what's going on with the home builders, and how Fed policy is affecting the housing market. I talk about the new hotel minimum wage that Los Angeles City Council has just unanimously or almost unanimously passed, $15.37 an hour, I think, something crazy like that. So I'm going to talk about the effects that I see coming for Los Angeles. Also, you won't believe I get into a talk that I heard the guy that heads the World Bank interviewed on Bloomberg. Not only was he claiming that our experience with QE, that America is a shining example for the world to follow, that we proved that QE worked. And you won't believe what this guy's proof that QE worked is. All of that on this week's podcast.
You make no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show.
Well, we did get quite a bit of economic data points coming out on the week. Let me start with the final day of the week on Friday, where we got the revision for second quarter GDP. And analysts were looking for an upward revision. Remember, the last revision moved the quarter up to 4.2. And now we've got it up at 4.6, which was pretty much bang on with what the consensus forecast was. I think there was an improvement in our trade deficit, not as small, so it didn't subtract as much from the GDP. And also a bit of a bigger pickup in fixed non-residential investment. The downside came in consumers because they actually had thought that consumer spending was going to pick up to 2.9. That was the main reason that analysts were looking for the 4.6, because they thought the consumer was going to end up being stronger. That was not the case. So the consumer was still at 2.5%. So that was considerably under what had been estimated. But remember, the 4.6% number, when you average that out with the 3.1% negative number for Q1, the average of the two now is at about 1.5% for the first half of the year. That is not a lot of economic growth for the first half of the year. And remember, the reason that Q2 was so big, other than the fact that it had all the holdover, all the activity that didn't take place in Q1 that took place in Q2 instead, but you had a lot of expenditures related to Obamacare that were in there. I mean, big expenditures on healthcare. And this is not money that people wanted to spend. This is money that government regulations forced them to spend. And so we spent a lot of money on Obamacare. That's hardly anything to celebrate, but it does end up padding the GDP numbers. Also, businesses loaded up on a lot of inventory. And maybe that was a mistake, because I think businesses are preparing for a second half recovery that I think is going to very much disappoint those who are preparing for it. I think they're preparing for something that's not going to arrive. And so I think that we're going to get payback in lower GDPs at the end of the year and maybe the beginning of 2015, as companies now have bigger inventories than they need and therefore don't need to order as much stuff as they otherwise would, because they're going to be stuck with a bunch of stuff that they ordered that they didn't sell because the economy is much weaker than they thought. So I think the second half is not going to be 3% plus, which is what the consensus is. People are looking for 3% or higher growth for the second half of the year, right? Which would be double the rate of growth for the first half of the year. I don't think it's going to happen. I mean, maybe we end up getting something in the low twos at best for the second half. But it might even be sub 2%. We could even have a one handle on the numbers. But I do believe that whatever we get in the second half of 2014, the first half of 2015 will be even weaker, right? The decelerating, the trend for weakness is there, right? And we have been getting, for the last several years, we have been getting a second half that has been better than the pathetic growth in the first half, but not nearly as robust as people believe. And so I think the same pattern is going to hold true, particularly considering that the Fed will no longer be doing quantitative easing, right? If Janet Yellen is true to her word, by the beginning of next year, there will be no QE, and the Fed will be closer to pulling the trigger on raising rates, right? So I think without all this extra help, even though rates will still at zero, people will be preparing for rates to not be zero, and the Fed will not be doing all this QE. I don't think the economy, the bubble economy, will be anywhere near as bubbly. Right? I believe that, the real estate market will continue to soften, and potentially by then will be an outright decline in home prices. The stock market could be quite a bit lower if we stay the course between now and the beginning of 2015. So I think the robust forecasts the people who have these forecasts are going to be very, very disappointed. Meanwhile, though, the markets, and I will get into the markets a bit later, but the markets are very excited about these GDP numbers. But again, they are backward looking, right? What you have to do is think about what is GDP going to be like in Q3 and Q4. Forget about what it was in Q2, because it was so, influenced by other factors like Q1. But of course, just like everybody ignored the first quarter because they said it was an aberration, they don't want to apply the same logic to the second quarter. They want to look at the second quarter as if, hey, that's how strong the economy is. It's not, right? Unless you want to accept how weak the economy was in the first quarter, and then you average the two together and you get 1.5%, and that's where we were. And that's not strong. And remember, that 1.5% was achieved with a lot of help from the Fed, help that isn't going to be there in the first half of 2015. We also got some numbers on consumer sentiment that came out today, and that number was pretty much bang on the consensus. So it wasn't better, it wasn't worse. But again, this is just opinion. Although on Thursday, we got the Bloomberg Consumer Comfort Index, and that one came out not only below the prior month, but quite a bit below what had been forecast. So that was one sign, at least on expectations. But remember, most of the good news that we've got has always been survey related, what people think is going to happen, not what things are actually going to happen. The PMI Flash Service Index came out at just 58.5. The consensus was 61. So we came out, 2.5 points below the consensus that matched the level from the prior month, but people were optimistic that it would pick up, and it did not happen. Durable goods orders, another bad number. Now, the last month, it was the biggest increase, I think, ever in durable goods, and everybody got excited, and it was all aircraft related. It was an increase to 22.6. They revised that down slightly to 22.5. But this month, the drop was 18.2. That's bigger than what they were looking for. And it's the biggest drop ever. So we had the biggest bounce ever, followed by the biggest drop ever. Also, if you X out transportation, transportations, the increase there was slightly below expectations. So you'd have to put this durable goods order in the negative camp for economic numbers. Jobless claims came out back up to 293,000 from an upwardly revised 281 from the prior week. That was a little bit below. They were looking for 300,000. So you can say, well, that was good news because the increase was less than expected. But still, it was a bigger number. And I expect that trend to continue. I think we're going to be back north of 300,000 consistently pretty soon when it comes to the unemployment numbers. On Wednesday, we got mixed news on the housing market. Although I think the scale would tilt in favor of negative. We got mortgage applications really plunging, not only for the composite index, which was down 4.1%, but the refi index down 7%. Obviously, mortgage refinancing drying up, even as mortgage interest rates are only moving up slightly. Of course, if you believe the Fed, they're going a lot higher. And so the negative impact on mortgage originations and refis is going to be bigger. We did get a better than expected increase in new home sales, right? 504,000. That was, I think, the highest in about 6 years, much bigger than the consensus for 430. But this is only about 5% of the market. And I'm not really sure what factors are responsible for those oversized gains. Because if you go back to existing home sales, that number was awful, right? Big drop from the prior month, well below expectations. Year over year, home sales down 5.3%. Now, month over month down 1.8%. And that's 95% of the market. So I think the housing news was weak overall, despite the fact that there was a blip on the new home sales, which is probably going to get reversed in months ahead. But overall, looking at these numbers, look at Tuesday also. We got the PMI manufacturing index, came out below estimates, 57.9 versus 58.1 estimates, down slightly from 58%. 5.8 the month before. So we had a lot of economic data that disappointed. But did anybody care? No. Nobody cares. I mean, the markets don't even react to the bad news. It's almost as if, nobody believes any of the bad news. I said this, people are so wedded to this idea that the economy is recovering that they are oblivious to. They've built a wall that kind of, keeps out anything that contradicts that narrative. So all the negative economic data is dismissed. And any little bit of positive data, they jump all over it. Aha, you see? So they ignore the negative data. It's a heads I win, tails you lose kind of approach where if it's negative, we don't care about it. And if it's positive, aha, that confirms that we were right. And it just kind of feeds the fire on the narrative. And, more and more people are talking about this, how great the economy is and, how the Fed's policies have worked. And we now know that they've worked and it's all being borne out. But it's all being borne out as a fantasy. It's all based on forecasts, things that haven't even happened yet. It's more about wishful thinking. And nobody wants to connect any of the dots. Right? No matter how large those dots may be or how obvious they may be to see, nobody wants to connect them. And I thought this kind of, being this oblivious to a looming problem. I thought it was bad in 2005 and 6, with respect to the housing bubble and, the impact that it would have on the banks and everything when the bubble burst. But this is by far a bigger bubble. And to me, even more obvious. But nobody is, bothering to think it through. All of the assumptions that people have made, how most of them are, mutually exclusive, where they've assumed certain things are going to happen that are impossible to happen simultaneously. They don't even bother to think that out in their blind acceptance of the recovery story, where the Fed can raise rates and the recovery will continue despite the fact that rates are higher. And that the higher rates will have no impact on the over-leveraged banking sector, corporate America, the housing market, the U.S. government, that it'll just take it all in stride. That the housing market and other markets that have been totally dependent on cheap money, they don't need it anymore. In fact, they can be just as vibrant without it as they were with it. So you have to really just throw all rationality and all thought away in order to stick with this narrative, in order to run with this narrative. But that is exactly what is going on. And that's obvious by looking at what happened in the markets and how the markets really were seizing on the non-existent good economic news with respect to the U.S. economy. And again, it's the field of dreams economy. If we build it, it will come. If we pretend, if we tell ourselves, if we just click our heels together and keep repeating how strong the economy is, it's going to happen. And every time, the Fed talks or somebody talks, it's all interpreted as being good. Although the stock market had a rough week. Every day of the week, the Dow Jones moved by at least 100 points. 3 days, it was 100 points to the downside, or 100 more. I think we were down over 200 points on Thursday. But the Dow finished out the week up 167 right on Friday. But still, it was a down week for the stock market. And the broader the average, the worse it did. NASDAQ was, I think, worse than the Dow, and the Russell 2000 was worse than the NASDAQ. In fact, the Russell 2000 is all the way back down to where it was in October of 2013. That's almost a year ago, with no gain at all in the Russell 2000, despite the gain in the Dow. What is it? Maybe 7% or so I'm not sure exactly what it is over the last 11 months. But the broader market hasn't gained at all. And of course, beneath the averages, there are a lot of stocks that have really been clobbered over the last 11 months. Some of the hardest hit, apart from the gold stocks, and I'll talk about gold in a bit, but the home builders. And I've been pretty negative on this sector for a while, and we had a lot of home builders making 52-week lows this week. Some of these stocks are at 2-year lows, not just 1-year lows, but 2-year lows. I'm looking at this chart at KB Homes, and it's at the lowest price it's been since December of 2012. And more important, and it's just one random stock I just pulled up, but we're breaking through lots of support. So to me, it looks like these home builders have put in significant tops. There's a lot of technical damage done to these charts. And so if you look at a longer term price chart for a lot of these home builders, to me, there's really nothing there, no support there until you get down to the 2009 lows. Some of these stocks double bottomed in 2011, 2012. They retested the 09 lows, and then they had the rally up to 2013. But they're rolling over. I think we're going back down to the lows. And that makes sense. I've been talking about it on this podcast, on my radio show for months, that the housing recovery is over. It's over. And the market is rolling back over. We had pretty big gains in home prices in 2013 and 2014. Double-digit annual increases. That party is over. And we're about to experience the hangover. And I'll talk more about the housing market later in the podcast. But the home builders, the price action in these home builders is certainly telling you that the market is going to slow considerably for houses. New constructions are going to slow. Prices are going to come down. And if Janet Yellen is basing her idea of a continued economic recovery on the housing market, on the foundation of wealth, and the increase in consumer spending associated with rising home equities and the extra employment that comes from a vibrant housing sector, that ain't going to happen. Housing's cooling off. Employment in construction is going to decline. Household wealth is going to decline as prices come down. And remember, a lot of these houses were bought for cash. They were bought by foreigners who are now making money on their foreign exchange with the stronger dollar. So even if these prices come down in dollar terms, they might still be up in euro terms or yen terms. And as the market rolls over, there's a lot of supply to come back on the market. And there's no mortgages. A lot of hedge funds and private equity guys, the speculators loaded up. They bought these houses. When they can see the writing on the wall, they're going to want to sell. And, one of the reasons that homes didn't go on the market in the housing bust of 08-09 is because they were so underwater that the banks didn't let the property sell. I mean, the homeowner had no incentive because if they sold, they wouldn't even get enough to cover their mortgage. And so it's a short sale, and you need the approval of the lender, and the lenders didn't want a lot of these short sales, depressing the market. But now you have a lot of cash buyers that have no banks in the way, and if the property is down 10 or 20%, they could just sell, just like they would if it was a stock. They don't mind cutting their losses if they can avoid a bigger loss or they need the liquidity. Remember, you have rising interest rates. You have the expectation of rising interest rates, and the housing market is topped out. Meanwhile, household formation is down. Wages are down. Real incomes are down. The jobs are not there. We have been creating jobs, but they're not the kind of jobs where you can afford a house and a mortgage. These are low-wage jobs that we've been creating. We've been destroying the jobs that would provide the type of incomes that would service a mortgage. So without the Fed, and the Fed is going to stop buying mortgages and start selling them, and they're going to start jacking up interest rates, which is going to make buying a house that much more expensive if you can even find a mortgage. No, it is done. You can put a fork in this housing recovery, and the home building stocks are showing you, again, 1 and 2 year lows. The Dow over 17,000. Everybody talking about a recovery, and the home builders are in bear markets. They don't even see the recovery. How can you have a recovery without the housing sector? The whole thing, all this QE, all this buying of mortgages and slashing of interest rates, it was primarily designed to help the housing market. And the stock market is already telling you, the home builders, that the best days are behind us and it's done. And the Fed is declaring victory and saying we're taking our cheap money and we're going home because we've solved the problem. Yet now the problem is about to get much bigger than ever in the housing sector. And the impact that's going to have on the economy, on the banks, on the FHA, on Fannie and Freddie, on the federal budget. Not only are the higher interest rates that the Fed is pretending that they're ready to unleash at some point going to hurt the federal budget because it's now going to have to spend more money on the enormity of its liabilities. But now, instead of getting a check from Fannie and Freddie from their profits, they're going to get a bill for their losses. Because what's going to happen as real estate prices drop maybe 10% or 15% in 2015? A lot of people are going to be underwater on their mortgages. A lot of people bought houses with just 3 and 4% down. What are they going to do? We know what they do. They don't send in their mortgage. They send in their keys. Or better yet, they don't send in their keys. They keep their keys. They just stop paying their mortgage, and they live in their house rent-free for years before they can get around to kicking them out. But as these prices start to go down, we know that the speculators who own these properties, and they couldn't find any tenants, these are vacant single-family homes, they have no mortgage, just sell. Just sell. So the home building stocks not participating and basically flashing a red warning sign that's very bright, yet nobody seems to care. Certainly not the currency traders who bid the dollar up to new highs for the year, across the board, dollar index going out now above 85, right? Almost 86, 85 and 3/4. We were below 80 not that many weeks ago on the dollar index. So we've had a big run in the dollar across the board. I mean, the dollar's up against all the other fiat currencies. Big moves in the euro. Euro now down below $1.27, $1.26 and change. Canadian dollar down. Yen down again. Aussie, New Zealand dollar. In fact, the New Zealand government, even though the New Zealand dollar has fallen considerably, and the economic data out of New Zealand has been very good, and they had a very favorable result in their election, where the conservative, smaller government party won really a landslide, and the big government party that advocated higher taxes and more welfare really got crushed. So New Zealand really doing well. Despite that, the Reserve Bank talking down their currency, saying the currency is still too strong and needs to come down. Why? If the economy is doing so well, how do they know that it's not because the currency has been strong? Maybe if they talk down the currency, they'll also talk down the economy. I mean, how is it that all these geniuses are coming to the conclusion that what makes an economy strong is a weak currency? That what's bad for your currency is good for your economy and vice versa. They got it backwards. So none of this is going to help. But it is not sustainable. This rally in the dollar is all predicated, again, on the idea that our economy is about to boom thanks to the quantitative easing that we've already done. And now that it's about to boom, the Fed is about to jack up interest rates. Whereas Europe and Japan are going to follow our example because they've been hesitant about doing QE. But now that it's worked so well in America, they're about to launch it in their countries. And so we're going to be raising interest rates while they're lowering theirs, even though they're already practically at zero. So they're going to be launching new QE as we're unwinding ours. And so the dollar is going to go up and everybody else's currency is going to go down. Well, meanwhile, the euro has already dropped and the yen has already dropped so substantially. I mean, let's look at the euro. The euro has fallen so much. At this point, there's no need for Europe to actually do any QE. Remember, the justification for the QE was that there wasn't enough inflation. Well, this recent decline in the euro is going to give the Eurozone a big dose of inflation. I mean, look at oil prices in euro terms. And in fact, oil was up this week in dollar terms. It closed the day up 86 cents. This is Brent. And we're just under $94 a barrel in the price of oil. And last week we were down closer to 90. So this is a huge move up for oil prices in terms of the euro. And this looks like we may be putting in a bottom to this recent correction. I'm looking at oil prices in the U.S., which have gone down from $108, which was the peak in July, down to just over 90. And now we're starting to rally. If we can get above 96, which I think is the next resistance, and if we can get above 96 next week, then we could rally back up to 104, 106. And if we do that with the euro at the current exchange rate, that is going to be a lot of pain at the pump in Europe, not just at the gas station, but electric bills. And all this deflation talk is going to be gone because now all of a sudden you're going to be seeing bigger increases in prices, food, energy. They can't ignore that. They can't say, oh my God, we have this deflation scare when they're staring big price jumps in the face. So I think that they're never going to get around whatever this big QE program is that all the traders are assuming is going to happen in Europe. It may never happen because the weakness in the euro might have already taken the event that they're anticipating off the table. Meanwhile, the end of QE in America, which is something that everybody is also assumed, is going to be wrong too because our economy is rolling over, right? QE didn't work. It just exacerbated the problems and delayed the consequences. So everybody is looking forward to this booming economy in 2015 and 2016. Instead, we're heading towards another bust, another big recession, another financial crisis, unless we get more QE, which means we will get more QE, which doesn't mean we're going to avoid the crisis. It just means we're going to get a currency crisis, the opposite of what is happening now. Everybody is buying the dollar and selling other currencies, anticipating this booming economy. Instead, we're going to get a collapsing economy and we're going to get massive QE. And the interesting thing, too, from my perspective, is if you think about the 2008 financial crisis, preceding that crisis, right, everybody was still optimistic, but maybe they were becoming a little concerned about some of the problems in the housing market that began to emerge in 2006. But the dollar was weakening. The dollar hit its record lows in 2008 across the board. The dollar index was down near 70 in mid-2008. And gold was hitting new highs of about 1,000. I mean, it's higher now, but at the time, it had just had a steady march from under 300. So gold was going up. The dollar was going down, leading into the 2008 financial crisis. The opposite happening this time. The dollar is going up. Gold is going down, leading up to this crisis. So people are doing the opposite. And when the crisis emerges that they do not expect, they are going to unwind these positions. Just like they dumped currencies and bought dollars and dumped gold in 2008, they're going to dump dollars and buy gold, I believe, when this next crisis hits that they are unprepared for. But it's not going to start as a crisis. It's going to start with the Fed doing an about face. I don't know how much longer the Fed can maintain this pretense. Remember, after QE2, it took a while before they finally admitted that they would have QE3. I said it for long. You can go back and look at the interviews I gave and the talks I made on my radio show between the end of QE2 and the beginning of QE3. All I talked about was that QE3 was coming. As the Fed was denying it, nobody thought it was going to happen. Right? I had that bet with Steve Leisman that he refused to pay because he said it took too long. He said, there's not going to be QE3. Well, he said, it didn't happen immediately after the end of QE2. No, they waited. They waited a while before they sprung it on us. But I was sure that they had it up their sleeve the whole time. I knew that QE2 wasn't the end. Just like I know that this QE isn't going to end. Because it's not going to work any better than QE2 did. Why was QE3 followed up by QE2? Because QE2 didn't work. And is QE3 going to work? No, because it's the same thing, only bigger. So it's going to be followed up by QE4 or whatever it's going to be called. But they're going to do it again. They have to do it again, but they can't admit it now. They can't admit it's already failed. They have to pretend it succeeded for a while. So then when something goes wrong, the solution is just to do more of what we know works instead of admitting that what they thought worked didn't. So how long is this pretense going to last? How much data is going to have to come out bad? I think what we need is another bad non-farm payroll number like the one we got last month. And we need to get a look at Q3 GDP, which I think could be considerably below the estimates. So we get some weak numbers for Q3 GDP. We get some weak numbers for the housing sector that's going to come out. And I think that's obvious that those numbers are going to continue to weaken. And we get some bad non-farm payroll numbers. And we start to get an uptick in the unemployment claims. We get back up above 300,000. Maybe we even see an uptick in the unemployment rate. And Yellen is going to have to blink. She is going to have to come out and say that we were data dependent and the data is weaker than we thought. And so we need to step back on the gas. We need to do some more QE. Because that's all they can do, right? If the economy starts to slip, they have to buy some insurance. They can't just come out and say, the economy is weakening, and so the considerable period of time that we're going to allow to elapse between the end of QE and the first rate hike is now longer. They can't play with the considerable period because there is no finite period there. It's just a considerable period. It could be anything. So you really can't, what is it going to say? An extremely considerable period? We're going to wait. I mean, the only thing the Fed can do to try to guard against a downturn. And again, if the numbers start to get worse, What is the Fed afraid of? That it's like a snowball rolling down a hill. And in fact, if the Fed doesn't do anything, the numbers will continue to get worse. If the Fed conveys the message to the markets that it's going to tighten no matter what, that even if the economy is weakening, we're still going to tighten, right? That means they take away all the hope of continued QE and cheap money, then it's going to accelerate. Then the market really starts to go down. And that is another thing that could unnerve the Fed, would be if this recent volatility in the market is the sign of a top. And certainly the broader averages, as I said, are already breaking down and topping out. And you have key sectors like the home builders. And you have certain stocks that are related to the consumer. We had bad numbers out of CarMax. You know, they sell a lot of used cars. And when their earnings came out and disappointed, we had a big drop in shares of CarMax. And you start to get companies like this dropping on bad results. That's another thing. And again, it's not just the housing market that the Fed is worried about, because this recovery was built on a foundation of asset bubbles. If you think that's a solid foundation, apparently the Fed does. But as the air is leaving these bubbles, what can the Fed do? They can't allow the bubbles to deflate, because there goes their recovery. So sometime between now and the end of the year, and maybe even, I don't know, I guess there's not that many months left, right? This is the end. In fact, the quarter is coming to an end. Maybe, I think it was today, the end of the third quarter, as far as the stock market, the end of September. I think so. Then we've just got, October, November, December. We got those 3 months left of the year. But we're going to get all the data on Q3. We're not going to get the data on Q4 until the beginning of next year. But in Q4, I think is going to be worse than Q3, because I think the trend is going to decelerate. And I do believe that retailing this Christmas is going to be very, very tough. And I think that is going to usher in a whole new round of layoffs at a lot of these retailers, especially with more minimum wage hikes kicking in. An added incentive. You're selling less stuff, yet you have these higher payroll expenses. So a lot of this negative news is going to come out to shock people into reality. Because when the Fed has to admit this, nobody is expecting this. Nobody is expecting it. So these markets are going to have to turn, and they're going to be vicious when they turn around. Because everybody is going one way, and they're going to quickly have to turn around and run the other way. And it's going to be dangerous, especially in the derivatives markets. And there's a lot of exposure in derivatives, in the banks, to these markets not behaving the way they're behaving now, doing something that is against what the consensus view happens to be, right? There's green skies forever, dollar strengthening, great, strong U.S. economy, tighter interest rates that don't upset economic growth. When people realize that everything that they've believed is wrong, which is what happened. Look, remember how quickly the mortgage market imploded, the subprime market imploded? Everybody believed in these subprime markets and the safety of these mortgage-backed securities backed by subprime. How quickly it evaporated, how quickly the confidence that never should have been there in the first place evaporated. Well, that is what's going to happen in this situation as well, and it's going to be very abrupt. But the crisis is not going to come at that revelation. That's the turn in the markets. That's the turn in the dollar. That's the turn in gold. The crisis that we have that really accelerates the process is when the dollar decline turns into a rout. So the dollar just going back down. I don't know where the dollar is going to top out, whether this is the top, 85, 75, maybe the dollar index gets up to 88, 89. I don't know. I don't have a crystal ball. But when it starts to decline, the crisis isn't when it goes back down from 88 to 80 or even 75. It's when it breaks below 70. It's when it's really starting to free fall. It's when consumer prices are really starting to rise. When inflation, even as the government acknowledges it in its official measures, is much higher than anybody could comfort. And the Fed does nothing. The Fed excuses it, acknowledges it. What amazes me is you got Janet Yellen at the helm. She's got her arm on the printing press, and people think she's some kind of gigantic hawk, that we're going to have tight money and a sound dollar at the hand of Janet Yellen, when she is the biggest dove to ever build a nest at the Federal Reserve. She is not going to preside over a strong currency. She is going to sacrifice that currency on the altar of jobs and economic growth, because that's what she thinks will work. And the fact that so many people are buying this head fake. But the real crisis is when people realize that the Fed has lost control, that inflation is going to run out of control, and that QE will never end, because it cannot end. Because we have so much debt that it can't end. We can't allow interest rates to go back to normal, because at this point it's impossible, because there's too much debt. And that the whole economy is one big bubble. It's one big illusion. And all the Fed can do is to keep the illusion alive as long as possible. But once the bondholders, the dollar buyers wake up and realize it's an illusion, the dream is going to turn into a nightmare for investors who are not prepared, and for Americans who are going to be confronted with a rude reality when it comes to our true status and our true standard of living. And hopefully, those of you who are working with us at Euro Pacific Capital, you see the dollar going up, and that does undermine the dollar price of the securities around the world that we own. And as people maybe take a look at their statements for the quarter, and they notice that there has been a decline, the vast majority of that decline is currency related. Not necessarily the stocks that we own, but the currencies that they're denominated in going down. And so that is going to be a drag on our quarterly performance. But what people should do, and whether you're have an account with us or not, you should take advantage of this phony dollar rally of these idiots who are piling into the dollar because they believe in a fantasy that is impossible, because they've lost all rational thought. They believe in things that can't possibly happen, and take advantage of the price action, of the anomalies. Take advantage of the overvalued dollar to use your dollars to acquire foreign currencies and then foreign denominated assets, buying stocks around the world with your overpriced dollars, by selling these dollars to the fool who doesn't understand what is about to happen, who really believes all this nonsense about what the Fed is going to do and what the U.S. economy is going to do. And you take advantage of that mispricing of assets, or in this case, currencies, to sell your overvalued dollars and accumulate undervalued foreign currencies and buy assets on the cheap in those countries, and take advantage of this. Use this opportunity to your advantage. Don't be upset. The foreign stocks I own have gone down. Think about the opportunity. The dollars I still own have gone up. So let me do something with them. Let me convert them. Let me take advantage of this moment, this opportunity given to me by the markets and all the fools who don't know what I know. And let me sell these dollars and buy more of these foreign stocks and bonds and build a better portfolio and be prepared for the real crash that is definitely, in my opinion, coming.
The Peter Schiff Show.
An article that I read during the week had to do with the percentage of low-paying jobs in the United States as a percentage of the total number of jobs. And it seems that America leads the world in low-paying jobs, that we have the highest percentage of our workforce employed in low-paying jobs on a relative basis than any other country in the world. And of course, the reason for that is the hostile environment that has been created towards business, the regulations and the taxes and the legal system that increase the costs and undermine the opportunities for entrepreneurship. In fact, another statistic has to do with businesses being formed. Fewer businesses are being formed. Fewer American entrepreneurs are starting businesses. This is a disturbing trend that is continuing to accelerate throughout this supposed recovery. Not as many Americans are starting businesses. And a higher percentage of the ones that are starting are failing. And the businesses that are surviving are doing so with fewer employees. And there are, these success stories. You'll hear the stories about a small company, internet, social media. A guy starts it, drops out of college, starts it, and, they make a lot of money. And these are the stories that are in the news. And they're percentage-wise, it's like, winning the lottery. But these companies that go public and make multi-millionaires or billionaires out of their, 20-something founders, they don't have many employees. And so you've got these very successful companies that employ very few people. So the opportunities are drying up. Right? That's why household formation is falling. And those households that are forming, they're headed by a renter increasingly, not an owner, because the type of jobs that are being created do not deliver enough after-tax income to support a house. But what are we doing, right? What is America doing? What is the government's response to these disturbing trends? It's not to try to examine the root cause, to try to figure out why are so many higher-paying jobs being destroyed, and why are so many Americans now underemployed in menial, low-paying jobs, right? Instead of trying to figure out why that's happening, the response is, well, let's just force employers to pay people more money. That's the solution. Higher minimum wages, right? People are earning low salaries. Let's just force employers to pay low-skilled workers or people doing low-skilled jobs. You can be overemployed. If you're an astrophysicist, but you're cooking French fries, it doesn't matter how much you know about physics. You don't need any of that knowledge to cook those French fries. Just because you even understand the dynamics of the process involved in, how they're cooked, you don't have to know anything to cook them. And so just because you're smart, it's your productivity. If Einstein is cooking French fries, he's not going to be any more productive, than, your typical moron who's cooking French fries, right? Unless, he comes up with a more efficient way of doing it. But chances are he's not. It's just all rote mechanics, right? So what they're doing is they're trying to find ways of forcing employers to pay more money. And it's going to backfire. It's not going to work. One of the most recent examples is what's going on in Los Angeles with this new minimum wage that they've just enacted. City Council have passed it. So it might have one more hurdle to go before it's, cast in stone. But the City Council of Los Angeles, by a vote of 12-3, so I guess there's 3 members of this City Council who aren't morons. Although, for all I know, they objected to it because they thought the wage was too low. I don't know if I should give them credit without actually knowing on what basis they objected to this minimum wage. But maybe they objected to it for the right reasons. But they are going to have a hotel worker wage. And why does it only apply to hotel workers? It seems very arbitrary to just pick one particular industry and just set a minimum in that industry. But that's what they've done. And so if you are a hotel, you have to pay your workers a minimum wage of $15.37 per hour. Now, first of all, where'd they come up with $15.37? Why not just $15? 15 seems high enough, doesn't it? Why the extra 37 cents? What's the point? You're complicating all the math. 37 cents? What? Maybe that was a compromise. Maybe there were a lot of guys that wanted it to be quite a bit higher than $15.37. And that was maybe the average of where everybody was. I don't know. But there's no science to it. Because obviously it's not like, $15.37 is good and $15.36 is too low or $15.38 is too high. They're just, picking numbers out of the air. They might as well pick one even. $15.50 even would make more sense than $15.37. But $15.37, that's it. That is the new legal minimum. It's not going to go into effect until July of 2015. And that's if you have 300 rooms or more. If you have fewer than 300 rooms, but at least 125 rooms, you have an extra year before you have to pay the $15.37. And I'm assuming between now and then, you can pay the current minimum wage. Now, if you have fewer than 125 rooms, then you're exempt. Now, of course, what is going to happen here? Because whenever lawmakers pass a law, they just assume that the law is going to have no effect on behavior. That they just look at how many hotels have more than 300 rooms or how many have more than 125 rooms and just assume, well, this is how many hotels are going to be affected. And they look at how many people are employed in those hotels and they say, this is how many people are going to get raises. And of course, they're already looking forward to the positive impact it's going to have on the local economy because they're assuming that none of these people get fired and they all get raises and they all spend that extra money in the local community, meaning that Los Angeles City will benefit from all the higher wages earned by these hotel workers as they spend their increased income, which if you're a full-time worker, I think it comes to about $32,000 a year if you work 40 hours a week at this new minimum. As they spend the windfall at local businesses, it's all going to be great, right? This is what they all think is going to happen. Well, welcome to the real world. What is going to be the practical result, right, of this? Because nobody wants to think a few steps ahead to connect the dots. Well, first of all, if anybody has close to 300 rooms, if they have 302 rooms or 310 rooms, what is the most likely thing that they're going to do? Well, they are going to eliminate those additional rooms, right? They're just going to get rid of them. They will shut them down, and so they will not be required to comply. The same thing will happen a year later for the hotels with 125 rooms. If they have 126, 130, they will most likely just get rid of a few rooms to be under the exemption. And so what does that mean? Well, that means, A, not as many people are going to get the raises that are contemplated. But number two, there will be fewer hotel rooms available to rent, which means the prices of the rooms that are still there will go up. And it means that there will be fewer rooms available, which means maybe some people who might otherwise have checked into a Los Angeles hotel will check into a hotel in a neighboring city because the rooms will fill up. So there's fewer people to go out to a restaurant or go out to a museum or do whatever. So that backfires, right? Because none of the people get raises. They have to charge more for the hotel rooms, and maybe they get fewer guests. That's number one. Now, what about the mega hotels, right? The hotels that have 500 rooms or 600 rooms, right? Obviously, they can't get rid of half their rooms, so they're going to have to deal with this minimum wage increase. So how might they deal with it? Well, one way is just to raise the prices of their rooms. But of course, if they do that, it makes their hotel rooms less competitive relative to smaller hotels, which are not subject to the minimum. And so when they raise their prices, well, they're not going to have as many guests. And also, since people could stay in neighboring cities, whether it is Beverly Hills or Santa Monica or someplace on the border of Los Angeles, the larger hotels there will have an advantage. And so if they raise their rates, they will, by supply and demand, have fewer guests. And because they have fewer guests, they will not need as many employees, whether it's, bellboys or chambermaids or valet parkers or whatever it is. If they're not going to have as many guests because they're charging fewer guests, higher prices, well, then they're going to lay people off, right? So now jobs are eliminated and you have fewer tourists staying in Los Angeles. The same thing might happen to big conventions, because a lot of the people that come to Los Angeles in the city limits and stay in these big hotels downtown, these are convention businesses, right? But Los Angeles competes for convention business with cities not only in Southern California, but in Las Vegas and, Miami, San Diego, other places. Well, now they're going to be at a competitive disadvantage because they're going to have to charge higher prices for those rooms, and so they're probably going to not get as much convention business. That's going to reduce the number of people coming to Los Angeles. It's going to reduce the revenues to the hotels. It's going to reduce the taxes. Remember, the city has these occupancy taxes on all these hotel rooms. And if fewer people are coming to Los Angeles because now you've increased the price of a room, then they're not going to get as many, they're not going to collect as much taxes. So a lot of this is going to backfire on the city. It's going to undermine their revenue. It's not going to be an economic boom. And what is going to happen to these workers? So for the larger hotels, right, the hotels that have 400 or 500 rooms, okay, so they can't just, get out from under the impact. They're going to have to deal with the $15.37 an hour minimum. Well, how are they going to do that? Well, number one, we know they're going to lay a few people off because they're going to raise the prices for their rooms. They're not going to have as many people staying in their hotels, so they're not going to need as big a staff. That's number one. Number two, they will try to find more ways to economize and get by with fewer workers now that you have to pay them more. So maybe there will be less in the way of services for the hotel guests, more things that they can do themselves. By the way, the hotel operators were arguing that tipped workers should be exempted from the minimum, or they should allow the tips to be included in the $15.37 per hour figure, but that's not going to happen. So if you're getting tips, so if you're a bellhop, if you're a valet parker, if you're working at the hotel restaurant, you still have to get paid the $15.37 an hour, even if you are receiving tips on top of that, right? Which would mean that your income would be well in excess of the $15.37 an hour. So, yes, the hotels will cut back somewhat. So maybe more people will be, wheeling their own luggage up to their rooms, or maybe more self-parking as opposed to valet, or, whatever it's going to do. Or maybe they'll give you a bigger incentive, not to ask for your sheets to be laundered every day or your towels to be replaced every day. They'll try to find ways to reduce the amount of service that is required so that they can reduce the number of people that they have to hire. So there will be some other net jobs lost. But here's another important aspect that everybody overlooks. So hotel workers are making whatever, $8, $9 an hour. And now all of a sudden they're making $15.37 an hour. And this is, jobs that would normally pay $8 or $9 an hour. Now, a lot of people are going to want these jobs, right? Because they're really overpaying. They're forcing hotels to pay higher wages for unskilled labor than they would force a department store, a restaurant. So now the highest caliber people, right, are now going to be the ones that get the job, because everybody is going to want to work at these hotels now. If you're working, and you're getting $8 an hour, $9 an hour someplace else, you're going to want to send your resume over to one of these hotels, right? And now the hotels, now they're going to, now they say, well, we got to pay $15.37 an hour. So who do we want to have these jobs? Do we want to just give the current workers a big raise? Well, not really. They're not $15.37 hour employees. Maybe they were the best we can do when we were offering $9 an hour, but now that we got to pay $15.37, we can, get a whole different caliber of people that take this job. And they're going to get people. They're going to get people, number one, that are nicer looking, that are better dressed. Maybe they wear uniforms, but people that just are more pleasant to look at, more attractive men and women to take the jobs. They're going to get people who are more articulate, that have a better command of the English language, more educated. They're gonna look at resume. Maybe now they just want college grads. If they're paying $15.37, they could just say, we want you to have a bachelor's degree. Forget about all these high school dropouts. They can have all sorts of criteria that they didn't have before, because now they're paying all this extra money. And remember, there are a lot of people now in this economy that are losing better jobs. Let's say somebody, was making $50,000, $60,000 a year, and because of high taxes and high regulations, they lost their job, and now they're looking for a job. they might take one of these hotel jobs at $15.37 an hour. Maybe that's the best they can get. Now, so if you're currently got a guy who's, never earned $50,000 a year, he was just a guy making minimum wage, well, you could fire that guy and you can hire the guy that lost his $50,000 an hour job. You can afford to look for all these things. Also, in many cases, you're going to have connections to get these jobs because they're going to be inundated with applications, right? Whenever the government comes into a free market and sets a price, right? This is price fixing, right? You don't have the free market determining what somebody who works at a hotel should be paid, right? Where you have supply and demand, right? You have the government saying the minimum a hotel job is going to pay is $15.37 an hour plus tips maybe, so which would be a lot more. And so now a lot of people are going to want those jobs relative to the supply of those jobs. Now, in a free market, that wouldn't happen because the price would come down until supply and demand were in balance, until the number of hotel jobs available was equal to the number of people that wanted them. But now what you're going to have is all these people wanting to get jobs at hotels, but you're going to have fewer of those jobs available. I mean, fewer hotel jobs are going to be available at $15.37 than at $8 or $9. Remember how supply and demand works for both parties. As prices go up, right? Demand goes down, but supply goes up. And when it comes to wages, the supply of hotel workers goes up the higher the wages. I mean, imagine if hotels had to pay $1,000 an hour. Well, pretty much everybody in the country would want to work at a hotel, right? If it was $1,000 an hour, almost everybody would be sending an application. Everybody would. But how many jobs would be available? Well, if you forced a hotel owner to pay each guy $1,000 an hour, I mean, there might not be any jobs available, right? So it would be a massive shortage. Everybody would want the jobs, but none of them would exist, right? So as prices go up, as you force employers to pay more money, the demand for those workers goes down, but the supply of those workers goes up because they want the money. So now you've got the government coming in and they create a big surplus of hotel workers and a shortage of hotel jobs. So what happens? How do you clear it? Well, one way is going to be, connections. Getting a hotel job, again, a lot of it is going to be about connections, favoritism. Who do you know? How do you get one of these plum jobs? What strings can somebody help you pull to land one of these jobs? And so a lot of these jobs might end up going to the children of hotel executives. Hey, I got a high school kid, he needs an after-school job. I'll get him a job, as a valet bellhop or parker or something, because these are great jobs. They're better than they can get if they go anyplace else. So the children and the friends and the relatives of the executives of these hotel companies, that's who's going to get these jobs, the privileged, right? The people who have these jobs now, who actually need these jobs, they're going to lose them. They're not going to stay there. There's going to be massive turnover. These jobs, a lot of people, maybe some of these actresses and actors who are working at some of the restaurants, they might decide, the hotels are going to be working a hotel now. They might not have worked there before, and the hotels didn't want to pay them. They didn't want to pay these guys the extra money because they said, it's not worth it. I'll just hire, a guy, I'll hire this guy. He's not as attractive. He doesn't speak that good English, but, it's fine. He can do the work. But now that I got to pay all this extra money, well, why not? I might as well spruce up my image a little bit. Especially since I have to charge more money, since I have to charge my guests more money, they expect to have a nicer looking, more professional staff, right? And so this is what's going to happen. So all these people who are clapping and are so happy that they're going to get raises, they're going to get pink slips. Lots of people are going to get fired. It's not going to be a net economic benefit for Los Angeles. It's going to be a drag on the economy for Los Angeles. If anything, it's going to be a benefit to the surrounding cities, which will now have an advantage and will pick up additional business that is lost by Los Angeles. It might benefit hotels in other states that win the convention business that Los Angeles can no longer accommodate. right? There's going to be all sorts of changes in behavior to get around this minimum wage. And of course, one of the biggest changes is to reduce the demand for low-skilled labor, unskilled labor. The very people that the regulation is supposed to help are the very people that it is going to hurt the most. And of course, that is always the way it works when it comes to government. Anything they try to do backfires. Anytime they try to pass a law, pass regulation to encourage a certain outcome, it's the opposite that ends up happening.
The Peter Schiff Show.
Today's financial advisors behave like pro wrestling TV commentators. They scream that the recovery is strong, debt is manageable, inflation is low, and that the Federal Reserve has everything under control. They may be oblivious, but the danger is real. Looking beyond the media hype can open a world of broader investing ideas. Euro Pacific Capital is a registered investment advisor that offers stock-focused wealth management services that closely follow the strategy of our founder and CEO, Peter Schiff. We concentrate on those countries that are more closely in tune with Peter's vision of how capitalism is supposed to work. And these investments are not hard to find, provided you know where to look. Isn't it time you change the channel and let Euro Pacific put a little reality back into your portfolio? If you live in the United States and have $25,000 or more to invest, call 800-727-7922. That's 800-727-7922. Non-U.S. residents access similar strategies through Euro Pacific Bank at europacbank.com. Euro Pacific Capital and Euro Pacific Bank are affiliated companies.
The Peter Schiff Show.
We got some housing news during the week, and it was a bit of a mixed bag, although from my perspective, the negatives would outweigh the positives if you are a bull on housing. And of course, remember, the Federal Reserve is a bull on housing because they are betting the recovery on the housing market, right? I mean, you've heard that expression, don't bet the house. Well, obviously the Fed is betting the house because they believe that the housing market is driving the recovery, and they believe that the housing market will continue to recover even absent the Fed's support, which I think is a ridiculous exercise in arrogance or ignorance, or I'm not sure what, hubris. But let me go over some of the data that came out during the week. First of all, on Monday, we got existing home sales, and that is the bigger part of the market, right? You have existing home sales and you have new homes. And the majority of the houses that sell, probably close to 95% of the houses that sell, are existing homes. That's where somebody who owns a house puts it on the market and somebody else buys it. And they were looking for about 15.14 million units, and they only got, 5.14 million units is what they were expecting. And they got 5.05, which was a pretty big miss on the total numbers. Existing home sales month over month were down 5.8%, and they were down 5.3% year over year. And that's following a 4.5% year over year decline in the prior month. So you're seeing a significant decline in housing sales, resales, existing homes, and price gains are also slowing. So prices are barely up now. I think they're up 4.8% year over year. And at one point, it was about double digits. And so now the prices are coming down. Pretty soon, we're going to be printing negative year over year prices, which will show a bear market in home prices. Now, on Wednesday, we got more bad news when it comes to mortgage applications. Mortgages, the composite index was down 4.1%. Purchases were down slightly, just 0.3%, but refinances were down 7%. So a big drop in refinances and a smaller drop in purchases. Net composite index still down 4.1%. Again, the housing market is slowing, and the Fed is still blowing wind in the sails, right? They're not blowing as much. The Fed is still buying mortgages. They haven't stopped yet, They haven't started selling. I'm going to get to that in a second. But they're still supporting the market, and the market is already imploding. The only positive data, if you're a housing bull, was new home sales, which surged to a 6-year high. They were looking for 430,000 new homes selling, and instead we got 504,000. That is a big spike. I mean, some regions, I think out west, had a 50% gain, and this is the highest prices paid, I think, for new homes on a price. So what is going on there? Because to me, that's a bit of an aberration. Maybe it'll just, reverse itself next month. I don't know what seasonal factors might have come to play. But maybe it's some of the foreign buyers. Maybe it's some of the more high-end buyers that snapped up some of these new houses. Maybe that's why some of these home builders in their last survey were so optimistic, because there was a rush of new home sales. But that came at the expense of the existing home sales market, which is a much bigger piece of the market, and I think is a much more reliable indicator than what happens with about 5% of the housing market. But maybe some of the foreign buyers or high-end buyers, maybe some new projects, they snapped them up. I don't know. But I think overall, on balance, the news coming out of housing on the week was negative. But I had another thought, and I commented about this on last week's podcast. But if you recall, last week's podcast, I went over the Q&A with Janet Yellen, and she was asked about the unwinding of the balance sheet and how long it would take. And she said it was going to take a long time. And she said that, if we don't sell anything, if we just let our balance sheet naturally unwind, just let bonds and mortgages mature and not roll over the maturing principal, which is what they're doing now. See, today, anytime a bond matures, they just take whatever money they theoretically get and they use it to buy a brand new bond from the Treasury. So, they just roll it over. So the balance sheet doesn't shrink. But Janet Yellen says if we stop doing that, if we let the bonds mature and we just ask the Treasury to repay the loans and we don't make a new loan to enable it, right? She said that the balance sheet will return to normal by the end of the decade, or return to its pre-crisis level or something close to where it was pre-crisis, which would mean about $3.5 trillion less, smaller balance sheet. Well, one interesting part about it is the mortgages. Right now, the Federal Reserve has about 1.7 trillion in mortgages. And one of the things that Janet Yellen also said is that when the Fed shrinks its balance sheet back down to normal, that it will just own treasuries, meaning that it will sell all of its mortgages and just keep a portfolio of treasuries, which is what it had prior to the 2008 crisis when it didn't own any mortgages. Well, that would mean that over the next 5 or 6 years, the Federal Reserve is going to have to sell about 1.7 trillion worth of mortgages, actually more, because it's still buying mortgages. It's going to be buying them for a few more months, right? And so it's going to have to sell, maybe it's going to have to sell like $1.8 trillion worth of mortgages. Now, they can't just let the mortgages mature, because I took a look at the books, and most of these mortgages aren't maturing until after 2030. I mean, these are long-term mortgages, right? The average American's got a 30-year mortgage. These mortgages aren't coming due between now and the end of the decade. Maybe if somebody took out a mortgage in the 1980s rather, maybe it's coming due by the end of the decade. But if somebody took out a mortgage in 2003, 2004, 2005, they're not paying that thing off by 2020, not even close. A lot of these guys, they're negative AM. A lot of people that bought houses 4 or 5 years ago, they owe more than they originally paid. They're further off from paying off their mortgage than when they closed escrow. But so you got these maturities going out through 2030. So the only way Janet Yellen is going to get rid of all the mortgages that she's holding is if she sells them. Now think about this, because for the last year or two, the Federal Reserve has been the biggest buyer of mortgages, right? They've been buying mortgages in the secondary market. That has helped the housing market. Why? because mortgages are more valuable when you have the Fed willing to buy them. Banks are more willing to make a mortgage if they know they can sell it to the Federal Reserve at a profit, right? The Fed's there buying. And the Fed deliberately bought mortgages in order to stimulate the housing market by making banks more willing to lend because the Federal Reserve was there to take the mortgage off their hands. It was creating a market, a value, putting a bid under these mortgages. Well, what happens when the Fed is not there? Well, now the banks don't have that cushion. They don't have that big buyer for their mortgages. So now they're going to be much more cautious about their loans because they don't want to make as many loans, and they want the loans to be more solid. They want stricter lending conditions. They want, tighter ratios of mortgage debt to income, bigger down payments. All of these things are going to be happening as the Fed is raising interest rates. They're going to be raising interest rates, which are going to make mortgages more expensive, and they're going to be harder to get because banks are going to be tightening their standards because there's not the big buyer for the mortgages that they originate. But actually, it gets worse because remember, not only is the Federal Reserve going to stop buying mortgages, they're going to sell mortgages. 1.8 trillion. Now, if you sell 1.8 trillion over 5 years, that's 360 billion a year. If it's over 6 years, depending on, when the decade actually ends, it's 300 billion a year. But if the Fed goes from a buyer of, I don't know how many 100 billion a year to a seller of 300 billion a year, what is that going to do to the mortgage market? In fact, you know what it's going to tell me? If I'm a bank, I don't need to originate a lot of mortgages. Why should I have mortgage brokers or appraisers or deal with all the paperwork? I'll just buy mortgages from the Fed. Because after all, the Fed has told me they're going to be unloading all these mortgages. So why originate my own? Right? Why, there's going to be no shortage of mortgages out there for any of the financial institutions. I don't know, who else is going to buy these mortgages? I mean, I'm not buying them. Who's a buyer for mortgages? Banks, right? I guess Wall Street will buy them and package them up. But if they're buying them from the Fed, that means they're not buying them from the issuers. So if you have this huge supply of mortgages that's going to come on the market, why originate new ones? Right? Why give a new mortgage when you can just buy one? So you know what? The lending standards are going to implode. As difficult as it is to qualify for a mortgage today, if Janet Yellen actually does what she's pretending she's going to do, it's going to be so much harder to qualify, and the rates are going to be much higher. You're not going to be able to get a 4.5% mortgage. They'll be 6 or 7%, and maybe more. And if the housing market is already rolling over, which has been evidenced by almost all the numbers we see, while the Fed is still supporting the market, imagine how much worse it's going to be when the Fed is leaning on the market. Instead of propping it up, it's going to be pushing it down. The Fed must think that the housing market is so fundamentally strong that it can overcome these headwinds, these pressures. That despite rising interest rates and tighter lending standards, Americans are going to keep on buying homes. With what money? Where's it going to come from? Right? That home prices are going to keep rising. Because obviously, if tighter lending standards and higher interest rates prick the housing bubble and housing prices go down, then so does the GDP. So do the construction jobs. So does the consumption related to the housing. And what happens to the banks when all the real estate loans on their books are going bad? Aren't we right back in to the 2008 crisis? And what is the Fed's playbook? What do they do when you have a housing crisis? What do you do when real estate prices are falling? What do you do when home borrowers are defaulting on their mortgages? What do you do when the banks are in trouble? Why you bail them out? You do QE, you print money, and that is exactly what they're going to do. I don't care how much they talk about rate hikes in 2015 or 2016 or whatever it is, it ain't going to happen. Because before that happens, we're going to be slipping back into recession. The housing market's going to be too weak. The stock market's going to be weak, despite the fact that it's still up, right? Again, it's not gaining a lot of ground. But the main reason I think it's still being propped up is you have money flowing into the dollar, money flowing into our markets based on this belief that everything is so great here and so lousy every place else, right? The rest of the world is a basket. Although at some point, if everybody is so convinced that Europe is going to do QE and Japan is doing QE, why aren't people so excited about how strong the European economy is going to be? How strong the Japanese economy is? Why aren't they looking past the QE to the victory and saying, well, let's buy the euro, let's buy the yen, because we know these economies are going to boom, right? Somehow the only economy that's going to boom is America's. And maybe because we're just that many steps ahead, right? Because we did the QE first, and they were too squeamish about it. We just jumped right in, and they waded into the QE pool, and so we got a big head start. But the problem is we waded into an acid pool. I think that's what's going to happen is the Japanese and the Chinese are going to, when they see us fry, and maybe they've only burned their toe, they're going to realize, we're going to be the sacrificial lamb when it comes to QE. We're not the poster boy for the success of QE, but for the failure. People are going to learn, but they're going to learn from our mistakes. They're going to learn what not to do, not what to do. And it should be obvious, right? I mean, people should be able to put this together. It's not rocket science about what would happen to the housing market were the Fed to do what Janet Yellen is pretending that she's going to do. But, nobody wants to question anything, right? They just want to live with the fantasy, right? As I said, just like a little kid, doesn't want to try to question how Santa Claus can theoretically deliver all these presents in one night and how he can, get down all these chimneys and do all this and not miss anybody. And, and all the other things that you have to accept blindly to believe in it. Kids just want to enjoy Christmas. They want to enjoy Santa Claus. And they don't think about it. And if they did think about it, well, their mental capacities are still, developing. So maybe they don't think about all the intricacies. At some point they do. At some point they do stop and scratch their heads and they figure it all out. But it seems that economists and traders are even more ignorant. They never figure it out until it's too late. They need the safe to fall on their head. They need a big event to open up their eyes. But right now they just have no incentive to do that. They want to enjoy Christmas. They want to enjoy the presents. They don't want to question where they came from. They just want to enjoy them. And so right now people are making money based on this false narrative, whether it's making money buying dollars and shorting the euro or shorting the Swiss franc or the yen or the Australian dollar or the Canadian dollar or shorting gold or buying, internet stocks or whatever stocks people are buying. The narrative is working, and it works until it works. And when does it stop working? When reality rears its head. When will that day happen? I'm not smart enough to figure that out, but I am smart enough to prepare for it because I know that eventually it will happen. And I don't think that it's that far off into the future in the scheme of things. It's probably not weeks away, but it's got to be months away. I don't think it's years away.
It's the truth, it's the truth.
The Peter Schiff Show.
Well, Bill Clinton, former President Bill Clinton, the potential former first gentleman Bill Clinton, gave his annual Global Initiative conference in New York City. And I happened to be watching an interview with the head of the World Bank. Guy's name is Jim Young Kim. He's a Korean American. He actually is a medical doctor and he's an anthropologist. So not sure how he ended up heading the World Bank, but that's his current job. And he's talking about Europe, right? And what Europe needs to do to stimulate the economy. And the woman who's interviewing him, and I don't recall her name, and again, it's probably not that relevant, but she says, well, do you think there's going to be a lot of QE in Europe? Like, it looks like they're getting ready to do a big round of quantitative easing. What do you think about that?
Well, we sure hope so, and they're going to be buying some bonds. I mean, it's going to take time, but I think we've learned some lessons. I mean, one of the lessons we've learned is even at very low interest rates, central bankers can still have an impact.
Basically, what he says is that America is proof of how well QE works. That according to this guy, the head of the World Bank, America has set an example that the whole world needs to emulate. Right? The example that austerity does not work, that when you have a problem, you stimulate, right? If you have too much debt and you have an asset bubble, and the solution is more debt, right? That if you're drunk, you drink more alcohol, and that's what gets the party going, right? That we've proved that. We've proved the Austrians wrong and the Keynesians right, that a huge dose of money printing, of inflation, is all that's needed to restore economic health, right? We've proved it. And I'm thinking, wait a minute, we've proved it. How did we prove it? Right? What is the proof that all the QE has worked?
What we found is that I think in the U.S., with the growth numbers looking very solid for next year and the year after that, that these very unconventional monetary policies seem to have had an impact.
In other words, the proof that QE has worked is the fact that this guy thinks it worked, right? Because he said the proof is the growth forecasts for next year and the year after that. So the proof that QE has already worked is that we think the economy in America will be really good in 2015 and 2016. Well, how is that proof? How is a forecast proof of anything? Wouldn't he have to wait to see if the forecast pan out? Because a forecast is a guesstimate. It's an approximation. It's what somebody thinks is going to happen. Now, if you believe that QE works, you are going to build that belief into your forecast, right? So if you think QE is going to work, and now you're making a forecast of what the economy is going to be like in a year or two, and we've done all this QE, what is your forecast going to be? It's going to be for a lot of economic growth because you believe that QE has worked. You're biased. Your own beliefs have biased your forecast. And now this guy is offering his own biased, yet to be confirmed forecast as proof that QE has worked. I mean, is that how low the bar is now for economic proof? The proof is what we think is going to happen? Well, I guess that means that this guy knows that these are not just forecasts, that what people think are going to happen is going to happen. Like this is God himself has come down and given this guy the GDP numbers for 2015 and 2016. It's written in stone by the hand of God. And that's how we know that QE has worked. Because God has told us, we have seen the future, and we know how bright it is, right? He has already been to the promised land, and now he's come back to tell us how great it is. Now, of course, why would these forecasts be any more accurate than all the prior forecasts where they did QE and they thought things would be better, and they weren't? Remember, 2013 or 2014 is going to come out to be a lot slower growth than what all these Keynesians thought in 2013. And 2013 was slower than what everybody thought it was going to be when they were making the forecasts in 2012. So how do we know? How does this guy know that these forecasts that we're making now are going to be any more accurate than the forecasts that we made then? And the fact of the matter is, they're not. It ain't going to happen. QE has not worked. We haven't proved anything. All we've proved is that you can blow more air into a bubble. All we've proved is how stupid people are, how prone or likely people are to fall for the same thing twice. Right? You know that old saying, you can fool some of the people some of the time, or all the people some of the time, and some of the people all the time, but you can't fool all the people all the time. Well, when it comes to Americans, you can fool most of the Americans most of the time. Probably when it comes to traders and investors, you can fool most of those people almost all the time. But they won't be fooled forever. You can't fool everybody. And the bloom is going to come off this rose. There's just no question that it will. Because before these optimistic growth scenarios play out in 2015 and 2016, we are going into a recession. The numbers are there if people simply want to open their eyes and see what's going on. But even if you didn't have the proof of the slowdown that is happening, beneath the surface, or even not even beneath the surface, it's happening above ground and people are just willfully blind to it. But it only makes common sense. It is nothing but wishful thinking at best to say that after 5 or 6 years of QE and 0% interest rates, that we can bring those things to an end. And the economic recovery that we believe we created, which is based on asset prices and excess consumption financed by debt and inflated asset prices, that we can take away all the air from the bubble and that the bubble won't deflate. In fact, the bubble will continue to expand while the air is being withdrawn from the bubble. I mean, under what, world of physics can that happen? Right? You take away that QE. You've taken away the source. It's kind of like, in comic book character Superman, supposedly the source of his power is the yellow sun, right? Krypton was this red sun, and he got to Earth, and there was this yellow sun, and that's where his power came from. But, if you took away the yellow sun, Superman would lose his power, right? But according to, the head of the World Bank or all these economists, it's almost like you could take away the source of Superman's power, and he's going to be just as strong. He's still going to be able to bend steel in his bare hands and, have his X-ray vision and all that stuff. But obviously, that can't happen. You can't remove the source of the power and then expect the power to persist absent its source. Yet that's what everybody believes. Everybody believes that Janet Yellen can take the air out of the bubble, right? They could raise interest rates and not only not do QE, but reverse the process. Instead of blowing air into the bubble, they can suck it out. Yet the bubble's going to keep on growing as if you were still blowing air into it, right? That real estate prices and stock prices were going to continue to go up, despite the fact that the Fed is tightening and not easing, even though the ease was designed to lift asset prices. The Fed said, we're going to have this loose money policy to prop up real estate prices and stock prices. And now they think they can reverse that policy, and those high prices, not only won't they come back down, but they're going to keep going up. And they want to claim credit for this happening, even though it hasn't. You can't claim credit for completing something that is halfway done, or not even, because, the easy part of QE is ramping it up. The hard part is winding it back down, right? Letting the genie out of the bottle is easy. Putting her back in is a whole nother story, right? Just ask Larry Hagman, or I don't think he's alive anymore, but Major Nelson and Barbara Eden, right? Those genies can do a lot of damage, and it's hard to get them back into that bottle once you let them out. Or maybe that was Jeannie's sister. That was really hard to get into the bottle, but it was still Barbara Eden. But the point is, the hard part is still coming. It's like, a pilot doesn't claim credit for a successful flight while the plane's still in the air. You got to bring the plane back down to the ground. And I don't care how smooth the flight is, how nice your seat is, how good the meal is, how good the movie is, how few bumpy it is, if there's not a lot of turbulence. If that plane crashes, nothing else matters. It is not a successful flight, right? On the other hand, even if it's a lousy flight with a lousy movie and you're in a center seat, you're sandwiched between two fat people, if that plane lands, that's a much more successful flight than the comfortable flight that crashed. Yet they want to claim credit for QE, even though they haven't ended the process. They cannot claim credit until they've raised interest rates back to normal, until they shrink the balance sheet, which means get rid of $3.5 trillion worth of bonds and mortgages. If they can do all that, and the banking system is still sound, the economy is still growing, the stock market is still high, the real estate market is still high, the GDP is still growing, if they can pull off this miracle, then go ahead and say, I told you so. But until now, to have the head of the World Bank claiming that we've proved anything, that we're an example of anything, that we're an example that the world should emulate before you even know what it's going to be like. I mean, it'd be like saying that, Malaysian Airlines, before those last couple of planes went down, to say, look, yes, they've had a great safety record. Everybody should emulate Malaysian Airlines, and then the planes crash or they're shot down, whatever happens. It's going to be worse if you emulate America, because this is going to end in disaster. This guy is clueless if he thinks that this is going to end well, if he thinks that these rosy forecasts are actually going to pan out. It's kind of like if you're a drug addict and you claim that, you've successfully kicked the habit. And what is the proof that you've kicked the habit? The proof is that I plan on checking into rehab next year. Well, what kind of proof is that? You're still doing drugs. All you have is a plan to go to rehab next year. But you may be too drugged out to even show up. I mean, anybody can talk about something they're planning on doing, but that doesn't prove anything, right? How many of your friends have told you about their intention to go on a diet? At least they usually don't tell you, they don't brag about how much weight they've lost. And when you ask them, well, wait a minute, you haven't lost any weight. Well, I plan to. That's the proof that I'm going to lose it. I've lost it. I know I'm 300 pounds, but I'm planning on losing 100 pounds next year because of this great diet. And that's proof that I've lost the weight because I'm forecasting that I'm going to lose it next year. That is what this guy, the head of the World Bank, is saying with respect to quantitative easing. The proof that it worked is that we think it's going to work. The proof that it worked is that we think we're going to have all this economic growth next year. Well, what if we don't have all that economic growth? Are they going to say, well, I guess that proved it didn't work? No. You know what they're going to say? That just proves we need more. Because that's what they always say. If we don't get the economic growth because we have the QE, it's only because we didn't have enough QE. It's never because it didn't work. It's always because we didn't do it big enough. So that's all they're going to say. Because that's all they ever say. But ultimately, the world is in for a rude awakening. The financial markets, the currency markets, the metals markets are in for a rude awakening when this fantasy comes colliding with reality. I mean, I thought back in 2005 and 6, 7, that people were delusional. I mean, how could people be missing these problems that I saw so clearly, right? And I thought this was nuts, that people couldn't see this. Well, this is much, much worse. I mean, as stupid as I thought people were back then, I mean, they're way, way stupider now. I mean, they're basically relatively intelligent on that type of scale compared to how they are now. I think that globally, we have reached an unprecedented level of ignorance or stupidity or blindness when it comes to the economy. I mean, as blindsided as the experts were by the 2008 financial crisis, and believe me, right, they were all blindsided. Oh my God, how could this have possibly happened? Nobody could have seen this coming. Oh, what, Peter Schiff? No, that perma bear? Ah, well, he didn't see anything. Nobody could have seen this. As blind as they were, they're even blinder now. I mean, imagine the things they're going to say. And all the stupid things that they did in the aftermath of 2008 because they were so surprised and understood so little about what they had done. Imagine what they're going to do this time. Imagine what these geniuses are going to concoct to combat this much, much greater crisis that we are careening towards at the moment that nobody sees. Everybody thinks we've done everything right. Everybody thinks that we are the poster boy of economic success. The Europeans and the Japanese should just blindly follow our example. Not blindly, follow it because it's worked so well. Little do they know that we're leading them off the edge of a cliff. But I think the good news is they may be able to pull back in time. But America is going to go over that cliff.
The Peter Schiff Show.
One of the other stories of the week is the rollout of the new iPhones, iPhone 6, iPhone 6 Plus, and most of the stories have to do with the huge demand, right? All the people are gobbling these phones up, they're waiting online, they're snapping them up as soon as they can, and I guess the implication is, well, we must have this strong economy. I mean, you know, these phones are not that cheap, and Americans are just buying them like hotcakes, right? I mean, so this must be a sign of a strong, vibrant economy that, you know, so many Americans can afford to buy iPhones. But I think that what's really going on here is not evidencing a strong economy, but a weak one. You see, I think a lot of the iPhones that are being purchased, maybe even the majority, are being purchased not by Americans who have extra cash and they want to just buy the latest gadget, but they're being purchased by Americans who need cash and who are only buying these phones to turn around and resell them at a profit. You see, the iPhone was not launched in China, and it's not expected to be available for another several months in mainland China. They're in Hong Kong, by the way, but they're not in mainland China. And so I've read that phones are selling in China illegally for as much as 10 times what they're selling for in the United States. So in other words, a iPhone 6, maybe a basic model that goes for $300 here, is going for $3,000 in China. And so what's happening is that Americans who really have nothing better to do because they're unemployed are waiting in long lines, some of them spending the night in line, to buy an iPhone or two that they can turn around and sell. Now, I don't know if those people are directly selling them in China or whether there's 2 or 3 middlemen involved or who's buying them up, but the phones are not being activated. They're not tied to a contract. They're just being purchased and they're being flipped. And I even read an article here in Connecticut. A guy came from New York, drove all the way from the city out to New Haven to wait in a long line to buy an iPhone, and they got in a fist fight with somebody else, I guess, who was also waiting in the same long line to buy one of these iPhones, neither of which were going to be used. So the people who are waiting in line to buy these iPhones have no intention to use the iPhone. They're only waiting in line because they want to make money. I mean, who's going to wait in line? Look, I got an iPhone 5. I'm thinking about buying an iPhone 6, but I'm not going to wait in line and buy one. I think I can make do with my iPhone 5 for a few weeks until the lines go away. I mean, I'm not in such a rush. I mean, I've been using this iPhone 5 for a while now. A few more weeks aren't going to kill me. The people who are waiting in line, sleeping in line, driving for hours to get iPhones, it's because they're that desperate for the money. They want to make the few $100s that they can make flipping their iPhone to somebody who's going to smuggle it in to China. And so this is where all the sales are coming from. It's not that there's so many Americans that can afford these iPhones. It's that they're so broke and they have nothing else to do. When you're unemployed and you're not working at all during the day, you can afford to spend hours online so that you can get a phone to sell it to somebody in China who can actually afford it. But think about this. Think about the Chinese for a second. How bad could things be in China, right? People are now talking about, oh, the Chinese economy is slowing down. Yet the Chinese are willing to pay $3,000 to buy an iPhone? And Americans are willing to wait in line for days to buy that iPhone, to flip it to them? I mean, which country is poor? Where people don't have jobs and can spend all their day in line waiting to buy a phone so they can sell it to someone in China? Or the guy in China who's willing to pop $3,000 to be the end buyer of that phone? It seems like the boom is in China. The bust is in America. We're the poor saps that have to wait in line all day to buy a phone that we can't even afford to use. And the Chinese just buy it, and they're willing to pay all this extra money because that's how rich they are. I mean, think about it. How much money must these Chinese have in order to spend $3,000 on a phone that if they just waited 2 or 3 months, they could buy the phone for $300? Which also, this is more evidence, as if we needed any evidence. Of course, it's overkill. But all this talk about deflation, right? You got these Keynesians saying, oh, we can't have deflation, right? If people think prices are going down, nobody will buy, right? They say if prices are going to fall by 1%, if consumers know that the item that they want to buy will be 1% cheaper a year later, they're not going to buy it. They're going to wait it out. They're going to wait a year to get it for 1% less, right? Something costs $100. And if I think it's going to cost $99 in a year, I am going to refuse to buy. I am going to wait for that cheaper price, right? That is why we need to have inflation. We have to make sure that nobody believes that they can wait and get a better price. Because if they believe they can wait and get a better price, they'll wait indefinitely, right? Nobody will buy. That is the deflation argument. Well, here you got the Chinese blowing that argument to smithereens. Because you got Chinese buying iPhones today, when if they just waited 2 or 3 months, they can get them 90% cheaper. They can get them 90% cheaper in 2 or 3 months, and they still won't wait. They're still buying them. What does that tell you? This is all nonsense. People buy the things that they want when they want them. The only reason they wait. Now, there are some people in China who are not buying these phones for $3,000. Why? Because they want to wait for the lower price. But the people who can afford it, they're buying it because they want it now. There are people in China, I guess for the status, they want to be the first one to have that iPhone. And they don't care that it costs $3,000, right? They don't want to wait a few weeks, couple of months, and buy it for $300 because then everybody will have one. They want to be the very first one. They want to show their friends their big screen iPhone. And they've got the money to do it. They've got the money to do it. I have no idea how much money they have because there's no way I would spend $3,000. I mean, I'm not poor. I'm not a billionaire, but I mean, I'm all right. There is no way I would spend $3,000 for one of those iPhones, especially if I knew I could wait a couple of months and get it for $300, right? Why on earth would I, but how much money must these guys have that they're willing to do that? It's either they have so much money and they're so confident in their ability to keep earning money, right? Because, you have to be pretty confident in the future to be willing to blow so much money. And, the Chinese that are paying $3,000 for these iPhones, they're not putting it on a credit card. They're paying cash. They got $3,000 cash. The average American probably don't even have $3,000 in total net worth. Yet you got all these Chinese blowing $3,000 cash on an iPhone that they can have for $300 if they just were patient for a couple of months. Whose economy is in trouble and whose economy is booming? Right? The Chinese economy. Now, I don't know, why Apple has this marketing strategy. I mean, look how much money Apple is leaving on the table because when someone in China is paying $3,000 for an iPhone, Apple's not getting that money. There's all these middlemen that are getting this money, but Apple shareholders aren't getting a nickel of that. Now, I don't know, maybe the frenzy that they have in America, maybe all the images and how quickly they sell out, creates maybe some extra publicity and maybe makes the phone more desirable because now the Americans who want them, they have to wait to get it. And, sometimes it's like if you have to wait for something, it makes it more appealing. Like, the old, the Studio 55 model of a disco is you have a big crowd out front and you don't let people in. And then you keep a crowd, and then that makes people want to get in because it's like, oh, there's a big line. It must be really good, And then when you finally get inside, you feel like you've accomplished something. You're somebody special because you're inside. But of course, once you get inside, then you find out that the real club is, in the VIP room upstairs, and now you got to wait to get in there, and you're probably never getting in there. So you never really make it. But then the people who are in the VIP club, well, they really feel special. So what I think maybe Apple tries to do is by creating this false shortage, by having all these Americans rushing in to buy phones that they're going to smuggle into China, now the other Americans feel, oh my God, this thing is so popular. I mean, everybody wants it. Well, I want to buy it too, and I don't mind waiting, but I'm just going to feel so happy and fortunate when I finally get my iPhone because, so many people want it. But if these phones were available in China, then this would not be going on. I mean, you would not be having this frenzy to buy these phones. Now, whether this is a grand design that Apple has, publicity stunt, free PR, because it seems they do give up a lot of money based on, why not just sell these phones. I mean, if the Chinese are really willing to pay $3,000 to have the iPhone early, why not just launch an advanced, hey, we're going to come out with a limited supply of iPhones in China. If you want to be the first to buy them, here's what they cost. We're going to have general rollout in a few months and, keep that. Although, I don't know, maybe part of the allure of getting it early is the fact that it is illegal. I've often said that about drug laws. The government makes it illegal to smoke pot. And for many people, pot smoking now becomes more glamorous, more cutting edge. I mean, it shows, I live life, to the fullest, and I don't follow the rules, right? I'm a bad boy. Remember on that Seinfeld episode when George Costanza became the bad boy? All of a sudden, he got the girl. The girl wanted to date the bad boy, and so smoking pot when it's illegal. Well, I mean, it's your bad boy. You're on the edge. It's dangerous. It's exciting, right? If you remember during Prohibition, or nobody remembers, but during Prohibition, the number of speakeasies which were created, and the speakeasies were the bars during Prohibition, but there were more speakeasies in New York when it was illegal to drink than there were bars when it was legal. So the minute the government made drinking illegal, it made it glamorous. It made it exciting. It added that extra edge of, the forbidden fruit, right? And so, you ended up getting more drinking, not less. Just like maybe making drugs illegal, in addition to giving you a lot more crime, actually gives you more drug use because you've glamorized using drugs because you've given it that forbidden fruit taste. Well, maybe that's what's going on in China with the iPhone. Maybe because it's, people know they're not supposed to have it, that you have to buy it illegally. Maybe that's what makes people want them all the more. Hey, I've got connections. You've got the brand new iPhone. But the bottom line is the Chinese can blow this money because that's how strong that economy is. Anyone's going to tell you, China's weak, China's having a problem. They are snapping these things up like hotcakes at $3,000 a pop. How bad can it be? Meanwhile, here in America, we've got so many people without jobs that they can spend a Monday and a Tuesday on long lines, because they don't have a job, right? They don't have to show up for work. They can just stand on a line at a store that sells iPhones and buy one or two iPhones and spend their whole day doing it or their whole night. And then they don't even get the benefit of using the iPhone. They get the cash. It's the Chinese who get to use that iPhone because they have the cash. They have more cash than they need. And Americans don't have the cash that they need. And they have plenty of time because they don't have the jobs that they need. China, they have the jobs. That's why they have the cash to buy the iPhones. So it's not about a vibrant U.S. economy. With all these stories about all these iPhones being bought, it's all about the boom in China, the economic growth in China. None of it evidences a strong U.S. economy. In fact, as I said at the beginning, it simply evidences a weak U.S. economy where so many Americans have nothing better to do with their time than to wait on lines to buy iPhones for the Chinese and make a few $100 tip, right, is really what they're making in the process.
The Peter Schiff Show.
Those of you who have been listening to my radio show throughout the years, you've heard me talk a lot about the risks inherent in running a business, particularly in the United States, given the litigious nature of our society, and particularly to the extent that you happen to employ people, which is why I try to discourage people from hiring, because the more people you hire, the more legal liability you assume. And of course, in America, it seems like nobody takes responsibility for their own actions. If somebody does something foolish and suffers a loss, it must be somebody else's fault, right? Nobody ever accepts responsibility for what they do. They want to blame somebody else. And the courts are very happy to do that, and the lawyers are happy to participate. And of course, the person or entity that gets the blame the most is the company, right? If you are a business owner, if you are an employer, you are the one that everybody blames for everything. And you're the one that always gets sued. And it seems like courts or juries or arbitrators always feel sorry for the little guy. And although in many cases, the business owner is himself a little guy, but still it's the perception that the businessman, is rich and has all this money. And the U.S. court system really acts as another mechanism of redistribution of wealth from people who have money to people who have less money and who are perceived to be more deserving of the money. Well, that recently happened to me in a arbitration that I just lost in Florida. And this is an arbitration which, nobody would have thought if I told them the circumstances. They would laugh. Oh, that can't be. I mean, you can't possibly be responsible for that. Well, I mean, America is probably the only country where such a lawsuit would even be filed, right? Otherwise, it would just be thrown out of a court. But not only was it filed, but it proved meritorious in that the plaintiff won a judgment. Now, he didn't win everything he asked for. I mean, I guess thank God for that, right? Because they always ask for the moon. And so the guy didn't get everything he wanted, but the fact that he even got something is a disgrace. So let me just explain the circumstances so you understand what it's like in America today and how difficult it is to own a business. And this is not a difficulty that exists in a free market, because businessmen have a lot of problems to worry about without the ones that the government and the lawyers just superimpose on top. It just complicates the process that much more and basically makes it that much harder for businesses to get started or to stay in business, to grow. But anyway, so I had a broker who shall be nameless, who I fired. And we fired this guy for cause. It wasn't like we just fired him because we were downsizing. We actually thought he wasn't doing a good job. And so we fired him for cause. And on the U5, which is a form that the brokerage firms are required to fill out and file when they terminate a broker, if you terminate somebody for cause, you are supposed to put it on this form so that it's on this broker's record so that future employers, future brokerage firms, or future customers will have a record of this person's conduct at a prior firm, so because that would be relevant in their decision making as to whether or not they want to hire this broker, or for customers, whether or not they want to do business with the broker. So we put on the form, we let him go, and we said that we thought he didn't always have the customer's best interest at heart, and so we terminated him. The accounts were reassigned to different brokers throughout the firm, which is often the case. A broker leaves and the accounts are reassigned. Now, unbeknownst to us, this broker contacted this individual about a year after he was no longer working for me and convinced this individual to invest $200,000 with him. He wasn't part of another firm. He didn't get another job. He just theoretically created his own hedge fund, and he contacted his former client, who was still my current client, and got him to invest $200,000 with him. And he ended up losing $160,000 of the 200. He got $440,000 of it back. And the way he got it back is he contacted my firm after he had lost his $200,000. And the broker that he was using was very helpful in trying to pressure my former broker into at least returning the $40,000 of his $200,000. But apparently all the rest was gone, and so the money wasn't there. But my broker helped this client get back $40,000 of his $200,000. But he then sued me for the remaining $160,000, plus interest and lawyer costs and punitive damages and all the things that they wanted. Now, you might say, well, why, how am I responsible for this? And the reason I'm responsible, according to this guy, and now according to the arbitrators, I'm responsible because I didn't tell him that we fired his broker. And I didn't tell him why, even though I did tell him on his U5. And if you would have Googled this guy on the internet and you could have brought it up, broker check, all the information was out there. And of course, he could have called up our compliance department, his branch manager. He could have called up me and he could have said, hey, your former broker has approached me with an investment idea. What do you think of this guy? What do you think of the idea? Should I invest in it? He didn't do any of that. He simply claims that we didn't tell him that we fired the broker. Now, he also claimed that he did tell his current broker about the idea, but he has no proof that he did. He claimed that he emailed him about it, but he couldn't find the email, or he said he didn't have it. We have no record of receiving such an email, despite the fact that we have to store all of our emails indefinitely. So the broker said he had no knowledge that this individual was investing with our former broker. But basically, the arbitrators ruled in his favor, not totally. They didn't, they said I had to pay him $40,000 of the $160,000 he lost because they claimed that I violated my fiduciary responsibility to this customer. How? It's beyond me, especially when you consider what this guy did. My former broker told this client in writing that he was going to take his $200,000 and gamble with it on the outcome of sporting events, that he had a system to pick winners, and he was going to place bets on sporting events in a casino online, the Betfair Casino in London. And he had my client fill out forms in which the client signed that he knew that all this money was going to be used to gamble on sports and that he might lose all of his money, right? And that he was willing to do it. The guy was dumb enough to do that. And it's my fault that he lost $160,000. And he claims that, well, if I only would have told him that we fired this broker, that he would not have given him the $200,000 to gamble with. But because he was under the false impression that the broker quit, well, he felt totally comfortable in giving him $200,000 to gamble with. Although, according to this guy, even though he signed these forms that specifically said all the money was to be used to fund gambling, he said he had no idea that the money was going to be used for gambling. He thought it was going to be used in a hedge fund that had certain kinds of low-risk algorithms, or I don't know what he was saying. But I said, but wait a minute, that's not what you signed. And he said, well, I didn't read any of the documents that I signed, even though he signed and initialed in multiple places. So here you have a educated adult, intelligent guy who knowingly signs documents that he did not even read and sends a guy $200,000 to invest, even though he's gambling with the money, but he doesn't know he's gambling with it because he never read the forms that he signed. I have no idea that any of this is going on, yet I am responsible for his losses. On what legal principle? Well, I am a business owner, and I employed the person who he was dumb enough to give money to gamble with. And that is the nexus, that I was the employee. You see, there is no rule, no brokerage firm in the country, when they fire a broker, do they pick up the phone and call every client of that broker to inform them that they fired the broker and to go over the reasons for the termination, right? What they do is they just fire the broker and they reassign the accounts. And then, of course, there's a new broker. And when this account was reassigned, and when the client asked the broker, oh, what happened to my last broker? He was told he's no longer with the firm. That's all he was told. I'm your new broker. Your old broker is no longer with the firm. Let me introduce myself, and that's it. He didn't say anything negative about the old broker. That had been our standard operating procedure. We don't say negative things about people we terminate. I mean, also, you don't want to be sued by your ex-employees for, disparaging them, defaming them. But the client knows that the broker is no longer with us, and he has a new representative. But nobody, there is no requirement. All our requirement is to note the reasons for the termination. Now, the interesting thing is the guy who was, of course, represented by an attorney, in his lawsuit against me, they cite all sorts of precedents that they claim shows that we had this duty that we breached. But all of the precedents that they show are cases when firms fired brokers for cause, but who did not put that on the U5, meaning that a broker did a bad thing, and when they fired him, they didn't put that bad thing on the U5. And so now you have a customer who claims that, well, I looked at the U5 and there was nothing negative there, and so I trusted this guy. And had you done your job and put the negative information that you are required to put on that U5, had you put it there, well, then I never would have invested money with this individual and I wouldn't have lost it. But because you didn't do what you were supposed to do, I relied on that form and I lost money. Now, this is the stretch, but apparently the arbitrators, and there were 3 arbitrators, agreed in our case, we didn't omit anything from the U5. We put everything on the U5 that we were required to do. The problem is, this guy said that in addition to doing what we were required to do, we should have done another step. We should have called him up specifically to tell him that we fired this individual and why we fired him and what a bad person he was, so he would know never to do business with him again, so that if he did show up a year later asking him to give him money to gamble on sports, he would say, well, why would I let you gamble with my money? Because you were fired from Euro Pacific Capital. Of course, if he thought he quit Euro Pacific Capital, he's more than happy to give him $200,000 to gamble with. So, I did not have this duty, but now, of course, it has been fabricated. Now, I think what's going on here is you have a bunch of arbitrators who see, hey, here's a guy who lost some money. Here's a businessman. Here's a company that has employees and it's a profitable company. Let's just take some money away from this company and give it to this guy who lost his money based on his own stupidity. Because who is dumb enough to sign forms without reading them? Who is dumb enough to give money to a guy to gamble on sports? One of the crazy things is I talked to this guy and he said, well, the reason I trusted Paul so much is because I had done so well at your firm. The investments that he had recommended did really well, and so I just trusted him. I said, well, so because you did well with my firm, you took $200,000 out of your account with my firm and you sent it to your former broker who no longer worked for me? I mean, what does the one have to do with the other? And what does gambling on sports have to do with what his account was doing when it was with me? Absolutely nothing. I mean, I think they're grasping at straws. I mean, to be honest, I think even if we had done exactly what this guy claims we should have done, he still would have made the investment. The decision to make the investment was so stupid that I don't think anything that we could have told him would have changed his mind. Obviously, this broker completely won over this guy's confidence, and if we would have told him that he was fired, he would have had some explanation as to why it was all a misunderstanding and why he really didn't do anything wrong, and everything would have happened. And the guy still would have sued me, right? He would have come up with another thing that I supposedly did wrong. Because it really isn't about doing something wrong in America. It's about just finding a way to tie something to a business, right? An employer, just whatever you can do. So I think no matter what I had done, even if I did exactly what they're saying I should have done, well, they would have thought of something else that I didn't do, that I should have done. It is impossible. Basically, what it means is that if you are a brokerage firm and one of your clients loses money, it doesn't even matter where that money is lost. He doesn't have to lose it at your firm. He doesn't have to lose it based on anything that you did. Right? He could just lose money. If he can somehow relate those losses to your firm, if he can create a nexus to a employee or a past employee. Remember, the guy didn't even work with me anymore. And I'm still responsible, which makes me a little bit nervous about this other case, I'm not going to settle it. I mean, I'm going to take this one to arbitration too. And by the way, not only did I have to write the $40,000 check, I had to pay about $7,000 in arbitration fees, and I had to pay for 3 round-trip air tickets from New York to Florida, and I had to pay for hotels. I had a lawyer. Fortunately, he's an in-house lawyer, so I didn't have to pay the legal bills, because if I had a lawyer, it would have cost me another $50,000. But I had my own lawyer, but I had to fly him down there, and I had to fly my compliance guy down there, and I had to fly a witness down there. But I got this other situation in California, which somebody is actually helping me. Listening to my radio show, when I talked about it on my radio show, I had an attorney in California felt bad for me and offered to help me out pro bono, which I appreciate very much. And this guy is being helpful, but I am not as optimistic on the outcome as I was before I got the results of this arbitration. Because this is another guy who invested money based on a tip that he got from a former employee. Again, it's a former employee. This guy I didn't fire. This guy quit. But well over a year after he quit, this guy also invested money. He invested his own money. His own money. My former broker invests his own money in a Ponzi scheme. And after he makes that investment, of course, he didn't know it was a Ponzi scheme. He was dumb enough to think it was legitimate, right? So this guy innocently invests in what was a Ponzi scheme, but purported to be something legitimate. And he maintained a relationship with 2 of the clients that he used to work with while he was my employee. All of these employees, all of these accounts of mine had been reassigned to other brokers. So they all knew that this individual was no longer with the firm because A, he told them he was no longer with the firm, and B, we told them when we reassigned the accounts to the other brokers that they had been working with. Now, both of these guys who were friendly with my former broker also invested in this Ponzi scheme because I guess he was so excited about it, it came up in conversation. And so these other guys invested money too. One guy invests $25,000 and the other guy invests $175,000. Now, a couple of years later, right, they all find out they've been conned. They all find out it's a Ponzi scheme and they all lose their money. My former broker loses his money and my 2 clients, right? And these other guys are still clients of mine. They also lost their money. Now, of course, we have no idea they lost this money because we have no idea they made the investment. We didn't profit from the investment, just like we didn't profit from the money that was invested in sports gambling by the client who already won, right? We didn't make any money. We had no part in the transaction whatsoever. I had no part in this Ponzi scheme. And in this case, my former broker also got no compensation. He lost just like the other guys. All 3 of these guys were duped by the same person. Now, one of my clients has got a little bit of integrity and he's not suing me. He lost $25,000 and he admits that it's his own dumb fault and he knew it had nothing to do with me and he's not suing me. But the other client, who is now a former client because he's since transferred his account out since filing his lawsuit, he blames me for his losses. But he's not just suing me for the $175,000 he lost. Of course, no, you never do that. He's suing me for millions. That's the American way, right? You lose $175,000 because you fall for a Ponzi scheme and you blame somebody that had nothing to do with it. The only connection I had is that he found out about the Ponzi scheme from somebody who used to work for me. That's it. But now I'm not only responsible for the $175,000 he lost, he's suing me for $300,000 because he claims he was promised a 50% profit. And because he was promised that profit, he believes he's entitled to it. So not only do I have to pay him the money he lost, but the 50% profit he was promised, right? So I have to make the Ponzi scheme work. And he wants attorney's fees and he wants punitive damages. Punish me for what? What did I do wrong? Just like this other guy, they wanted punitive damages. What did I do wrong? Nothing. The only thing I did wrong was start a business in America. The only thing I did wrong was hire people in America. And apparently that is a big, big wrong. for anyone to do. Because if you start a business and if you hire people, you are the bad guy. You are responsible for everything. Anything bad that happens to anybody, if it's in any way related to your company or anybody who works for you or used to work for you, or if it's related to one of your customers, you are responsible. You are liable for their foolishness, their stupidity. Even if you're not 100% liable, this guy lost $160,000 and the arbitrator said, okay, Peter, you got to pay him $40,000. I don't know how they figured I was a third responsible for this guy's foolish decision to sign forms that he didn't read, to give a guy a couple $100,000 to gamble on sports. You know, I think these guys get greedy. They're promised a lot of money. This other client was promised a 50% return a year. Obviously, I don't promise anybody a 50% return a year, but this other guy did. It was a promise because it was a scam. If something sounds too good to be true, it is. So somebody promises this guy a 50% return, and he's dumb enough to invest money. And then when it turns out to be a scam, who does he sue? Does he sue the guy that stole his money? No, he sues me. And why does he sue me? Because I'm the business owner in America. I'm suable. I'm what they call the deep pocket. Who knows where this guy is? In fact, the lawsuit that I just lost, the guy who claims that he was scammed by my ex-broker, he didn't even sue my ex-broker. My ex-broker wasn't even named in the suit. The only person who was sued is me. Of course, he doesn't sue Peter Schiff. He sues Euro Pacific Capital. But of course, that's me. I own the company. I'm the only shareholder. I take it personally. And so now, you know, what happens on the record of my firm, there's another black mark. You know, not that I have that many, but there it basically says I had to pay somebody $40,000 because I violated my fiduciary responsibility. Which, by the way, we don't even have because it was a brokerage account. It wasn't even a managed account, so I didn't even have a fiduciary responsibility. Yet the arbitrators make one up anyway. And they impose upon me a duty I did not even legally have. And then they say I violated that manufactured duty, even though I did not violate it. What did I do wrong? I didn't call him and tell him what a bad guy his broker was. I didn't even know he was that bad. I mean, I guess it shows that we did the right thing by firing him. Although, theoretically, if this guy actually told my client that he was going to gamble with his money, and my client was dumb enough to give him the money, and then my former broker did exactly what he said he was going to do, he gambled it on sports and lost, did he really do anything wrong? I mean, the only thing I think my former broker did wrong was he violated his non-solicitation agreement, because I have a contract with this guy that says he won't solicit any business from my clients for 3 years. So the fact that he was calling them up in a year shows that he didn't honor the contract that we had. In fact, I believe that the real reason that this guy didn't say anything is that this broker told this guy, hey, don't mention anything about this to Euro Pacific because I signed a non-solicitation, and if they know I'm talking to you, then I'm going to get in trouble. So I think in order to protect this guy, he didn't mention anything about investing with him because he didn't want to get him in trouble because he liked him. And so that's why this happened. And so now, of course, in order to prevail in a lawsuit, well, people just lie. And of course, you know, when you lie, it doesn't matter. You can swear to tell the truth, and you're under oath, but big deal. I mean, there is no punishment for lying under oath in an arbitration. You can lie all you want. You can say anything you want. And then, of course, it's one person's word against another person's word. This guy even said under oath, he said, well, I sent an email. And we said, well, where is your copy? I destroyed it because I didn't want to get the broker in trouble. Yes, because, you know, he's not suing. There is a broker that he worked with that he claims he told he was going to make this investment. But is he suing that broker? No. The broker isn't named in the lawsuit. I'm the only one that he sees. I'm the only one that gets sued, not the broker that he theoretically told he was going to make this investment. And according to him, the broker said it sounded like a good investment. He said, it sounds interesting. Like, he didn't try to talk him out of it. But when we asked him, well, can you give us a copy of the email? Oh, I destroyed it. Well, we don't have a copy of that email, right? We have all the emails ever sent by any client to any broker, and it doesn't exist. So it's obvious that he's lying, but it doesn't matter. You can lie all you want and still win because he still won. So either the arbitrators didn't think this guy was lying, even though it was quite obvious that he was, or they knew he was lying, but they didn't care. They still thought a liar deserved to get $40,000 of my money. And of course, the irony of it is he's not even going to get $40,000 because the lawyers are going to take 40% for their contingency. So he's only going to get $24,000 minus his own share of some of the expenses. So maybe he's going to get $22,000. And of course, it's going to cost me $50,000 for him to get the 22, right? The rest goes to the lawyers and the fees. But meanwhile, I think that I am a much bigger victim than this guy. See, this client of mine, former client, thinks that he was a victim, right? Because he thinks he got taken by this broker. But you know what? He's not the real victim. I'm the victim, right? I'm the victim because I had no choice in anything. I'm just the only innocent bystander. He made his own mistakes. He was foolish enough to gamble with the money, right? I'm the one who's been robbed. I'm the one who's had money stolen from him. I had no say in the matter. I had nothing to do with it, and I'm the one that ends up losing. Sure, he's got losses, but, he's responsible for those losses. But now I have losses that he's also responsible for. And you know what, though? It's not so much this guy that I'm mad at. It's the country that makes it possible. It's the legal system that makes it possible. Why do we even have a legal system so ridiculous that we do this to our businesses, that we do this to employers, that we impose these ridiculous standards? Nobody takes responsibility for their own action. And no matter how much you screw up, it's never your fault. It's always somebody else's fault. And the somebody else is always a business owner or an employer. That's who we're going to stick with the bill. And it just, these are the reasons that people don't want to go into business. And there are so many firms out there. There are so many brokerage firms over the past several years that have gone out of business because they cannot withstand the cost of compliance and litigation. It is endless. It is endless. And, probably not a day doesn't go by where I don't think, when am I going to just stop? When am I going to get out of this business? When am I going to stop running a firm in the United States? Because it gets more and more difficult every day to operate a business profitably in America. And it's because of the government, the rules, the regulations, and the courts. And all of that is a function of government because it's the governments that are empowering the courts. That's it for today's podcast. I hope you're enjoying it. I hope you are sharing it with your friends. Don't forget to like us on Facebook, to subscribe to our YouTube channel, follow me on Twitter, and help me spread the word about the Peter Schiff Show in podcast format so we get more people listening on a weekly basis to 2 hours of economic sanity in what is really an insane world.